I'm going to start today by going back a little bit to and please interject. It's a lot easy. It's a lot more interesting and probably relevant if people ask questions or have thoughts when I'm talking. So I'd love for people to just put something on chat or ask questions if there's something you don't understand or something you think that's not been addressed. This is the usual graph I've shown for quite a while now. It's been a while since we've taken a look at it, so I'll recap. On the x-axis, you've got time, and then on the y-axis, you have three different scales. You've got in gray and black, essentially the 10-year minus the 3-month yield of the U.S. Treasury. In red is the equity market on a logarithmic scale, so the Wilshire 500, which is basically akin to the total market index. And then in purple, you have the credit subject index of the Chicago Fed. So typically what happens during recessions, as we said, is the yield curve inverts so that gray and black line go below zero. Credit conditions tighten, the purple line goes above zero and goes up. And then usually the red line starts going down. So equity markets correct. As we've seen, we had that inversion, tightening of the credit markets, but then we had a very, very quick recovery. And we're in this, and the yield curve is now continuing to steepen. So the last time we talked, the yield curve was probably around, what was it, 50 basis points. Now we're probably around 100 basis points. It's on the left scale here. So generally speaking, that means that the recovery is underway, that the process of healing is underway, because you have cheap money now and you've got a higher threshold for money later on. That means people have a positive view on the economy going longer term, because the 10-year tends to be driven by growth and inflation, and the front tends to be driven by the Fed, or what the Fed is doing. So essentially, at this point, I think it's highly distorted by the actions of the central bank, which is sort of a given. But the reality is that we've essentially averted most of the crisis for now. I also wanted to show this graph and just put it into context and show a similar sort of pattern that happened historically. If you look at this 1998 period, it's quite a similar type of logic, because you had a similar type of event. You had a sort of a one-off event in 1998, which was the Asian crisis, followed by the Russian debt default, and then the collapse of long-term capital management, which was a hedge fund. And so you had the yield curve that was very close to zero, almost inverted, credit conditions that tightened, and then you had Greenspan that came in and that eased. And if you take here, which was around the bottom of the equity market, which was around August 1998, and then the top of the equity market afterwards during the dot-com bust, which was around August 2000, you've got about a 2-year period. I'm not saying things are going to happen exactly the same, but there's a lot of parallels that you can draw between what happened in 1998 and what's happening today. So we had the coronavirus crisis, a very similar type, I mean, not the same type of crisis, but it's a crisis. The yield curve have inverted, the credit conditions tightened quite a bit, equity markets sold off, the Fed intervened and went with enormous amounts of liquidity into the market, and then the market recovered. So if we're suggesting the timeline is sort of similar, that means there's still maybe another year or so of ability for this equity market to run if we're just following the same timeline. So the fact that even if you think markets are potentially overvalued currently, that doesn't mean that equity markets won't go up. The other parallel that, again, I'm still following, and I'm bringing it back this to 1946. And the reason 1946 is a good parallel, or the 40s is a good parallel, is because this was the last time that we had such a big hit on GDP. The last time GDP dropped as much as it has in 2020 was in 1946. And it's when the Fed instituted yield curve control. Yield curve control means basically that the Fed fixes the 10-year Treasury and sort of fixes the 3-month, and then lets inflation go however it wants. So I'll explain this graph a little bit. The interesting characteristics to look at are the yellow curve, which is inflation, or CPI, so inflation. The red curve is, again, the stock market. The blue curve is less interesting, but it's basically unemployment. And then the green curve is, again, less interesting, and it's real growth, so GDP growth. And you see that 1946 dropped quite a bit. The reason I'm bringing this up, and then you have the black curve, sorry, the black curve here down on the bottom is the 3-month treasury. And then in purple, you have the BBB corporate bond index. So a few takeaways from this. So if you use it as another parallel, well, the Fed basically was easing and was almost an unlimited easing from roughly 1940, call it 1940 to 1945-ish, so the end of the war. Yield the front part of the curve stayed very, very close to zero. So that's something that wouldn't be surprising for us to see going forward. Inflation actually went all over the place because they weren't targeting inflation anymore. They were letting inflation go more or less how they want, where it wanted to. It actually hit in 1942 something like 13%. Bear in mind there was a war. While the yields didn't really move that much because they were basically keeping yields under wrap by the Federal Reserve. However, during that period, the equity market actually went up. And again, from call it 1942, even though they had high inflation, until 1946, when the Fed said they would stop essentially doing yield curve control, that's when the equity market tanked and inflation picked up because they basically unwound their liquidity facilities, and then you had basically a crisis. So just bearing that in mind, the fact that equity markets are going up isn't necessarily a sign that the economy is healthy, but it doesn't mean that it's not going to stop. Just to the point that the economy is not that healthy, here is a graph of unemployment. So it's inverted. So the green line is unemployment inverted. So when it goes down, that means there's more unemployment. So it goes the same way sort of as the stock market, or you think the stock market would go down when unemployment goes up. And the blue line is the 4-week moving average of initial jobless claims. And I divided by 5 because otherwise you can't get the two on the same graph. It spikes so much. So what you see is that both initial jobless claims and unemployment tend to spike when you have a recession. And they tend to be more or less a coincident or slightly lagging indicator. The thing that I want to point out here is that this is huge still, what's happened on the employment level. So there is, again, I think I've said this before, but make no mistake, if the Fed were not to intervene, there's a high likelihood, and the federal government now with the stimulus, there's a high likelihood that we wouldn't be in the same situation on the equity markets or in the economy for that. So the employment is concerning. It's starting to recover pretty quickly, to be fair, but it's still worse than it was during the 2008 financial crisis. Moving on to sort of an update to an equivalent to the P ratio. So just to remind people, CPA tax is essentially the profits of U.S. companies as evaluated by the IRS, as reported to the IRS. So it's the same thing as what you would call earnings. By the difference is this is what they actually have to report because they pay taxes on it. So this is a legal requirement as opposed to earnings can often be constructed from a GAAP perspective and doesn't necessarily hold legal requirements. So on the x-axis, you have that ratio of essentially their profits to their share price to their profits. And then on the y-axis, you have the 10-year future returns. So we've been progressively, so that orange dot is the latest quarter, so as of December 2020, and all these other dots are quarters starting since 1947. We've been progressively going since to the right, so essentially our P ratios have been increasing, and what that means basically is that the future returns have decreased. So I think about 6 months ago, we were probably around the 7% threshold. This is nominal. And right now, we're probably saying that the next 10-year future returns are probably around 6% nominal. That means that, and if you consider that inflation probably is, call it 2% during that period, that means that there's a 4% return real on the equity markets going forward. So it doesn't necessarily mean that they're great, but it's still probably the best return in town at this point. And then this just showing you what if you were to regress, so what this straight line looks like is the orange line here, and all these blue dots is the blue line here. Essentially, it's the regression versus the actual being the blue, and the regression being the yellow. So it's pretty snug to what is actually realized. So when the orange and the blue are on top of each other, that basically means the forecast and the actual 10-year returns match. And when they're slightly off, that means that there's a difference between the next 10-year future returns and the actual predicted value. You don't have anything here from the blue line because you don't have anything predicted for the next 10 years starting in 2010 because we're in 2020. So what we're currently predicting on this graph for starting 2021, call it, is about 6% going forward for the next 10 years on a nominal basis, again, not on a real basis. Moving on to gold. I could touch upon credit. Credit is not very interesting right now because credit has basically credit yields have kept on compressing, which basically means credit spreads can't really go much lower. So the return on credit is not going to be great. So when you're thinking about portfolio, you think about equities, you're thinking about fixed income, and you're thinking about essentially inflation hedging instruments, which typically gold tends to be one of them. So U.S. Treasuries, I think the 10-year is probably around 1% right now, 1.2%. The 3-month is around 0. So you don't have much yield coming from that, but they can serve as a diversification to your portfolio. Then you have equities, and then you have gold. So I think more and more people are looking at gold. A lot of people are looking at Bitcoin and are calling it gold. But you have a lot of people looking at gold because it's even more potentially of diversification if you have a lot of liquidity that's being injected into the system. One of the things I just wanted to comment on is that gold has pulled back recently, as you can see on this graph. So on this graph, you basically have blue line is the price of gold, and the red line is the long-term average inflation index treasury bond. So essentially, it's real rates inverted, so flipped upside down. And the reason you do this is because gold is considered a long duration asset. So what that means is basically it trades like it doesn't have an expiry date when it's long duration. It doesn't really have an expiry date. The value of gold is held in perpetuity. So it's in that sense it's a long duration asset. So you look at it versus long term yields. And so the reason these things should go together is that gold is often driven by debasement in inflation. So when real rates go down, it's a lot less costly to hold gold because that basically means inflation is picking up because the real rate is the nominal rate that you see on the treasury minus inflation. And so what we've seen is that gold is pulled back a little bit, but that's not too surprising because real rates haven't really gone anywhere more recently. And gold got a little bit ahead of itself. As you can see, it's spiking a little bit higher. So the fact that it's pulling back a little bit is not too surprising. It probably has room to pull back a little bit more. You need real rates to move more for gold to start being important. The other for gold to start picking up. The other possibility is a movement on the U.S. dollar because gold is a sort of a combination between inflation and the U.S. dollar. So if the U.S. dollar were to depreciate some more, you probably see gold go up again as well. So I'm going to pause there for a few seconds and see if there's any questions, and then I'll go on to sort of considerations around Fed hiking and inflation. Any questions, any thoughts?
Yes, Daniel, what was that thing again about, you said when real rates go down, gold will, and I missed the last part of that.
So when real rates go down, gold should go up. So this red line is, you put a minus sign in front of it, so it's flipped upside down. So that means when the red line goes up, that's real rates going down. So it's just to show you that they move in sync, and that gold price, when the gold price goes up, it's when the real rates are going down. Does that make sense?
Yes, great. Thank you.
Okay. So the big question has been around inflation and what the Fed is going to do. So the major question is, what is the probability of the Fed hiking? And then what is the possibility of fiscal stimulus? So on fiscal stimulus, I'll address that right now. We've seen that Biden has put in a plan about, I think, slightly short of $2 trillion. The one concern that I would have in terms of it stimulating the economy is that giving money to individuals on their bank account doesn't provide the same stimulus or growth prospects as getting money through wages. So when you as a person, if you get a windfall amount of cash, you have a bigger propensity to save it than if you get that money through a constant stream of your wage increases. So generally speaking, inflation tends to be driven more by an increase in wages than it is driven by an increase in sort of handouts or government stimulus checks. That being said, if the Federal Reserve and the Treasury were to put $1 billion on everyone's account, I'm pretty sure everyone would go out and buy a bunch of stuff. So it would create inflation. So there's a threshold, but dollar for dollar, it creates more inflation through wages than it does through stimulus. Does that make sense? So the goal of the Federal Reserve and of the Treasury right now is to create inflation, because they don't get enough inflation, and because inflation shows that it gives a threshold to investment to a certain extent, because that means people need to deploy their money if they don't want to lose money, and they can't just hold it in cash. So one of the things that a lot of people are looking at is, when is the propensity for the Fed to hike? Because if the Fed starts hiking, that'll probably put a dampener on the equity markets. And as you see in 1946, when the Fed released its constraint on interest rates, that's when the equity market pulled off. And then similarly, in 1998, the Fed started hiking. That's what popped the dot-com bubble as well. So the question is, when does the Fed start hiking? So here there's analysis, this is by Goldman, that took 3 different ways of looking at it, which I found interesting. And it's the probability of liftoff, essentially taking rates off of the zero level. Right now we're at 0 on the short-term treasuries, given the time period. And so they have 3 ways of looking at it. So the first way of looking at it is this, essentially just the probability that we reach 2.1% on what they call core PCE. PCE is just another word for CPI, which is just another word for inflation. And 2.1% is what is the target for core inflation, which basically excludes food and energy, which tend to be very volatile. And that 2.1% target is what the Fed needs to reach, or what it's set as its target to reach. It wants to average 2% on average. So it's underperformed inflation over the past decade, call it. And so now it's talking about trying to hit its actual target, which is 2%. So 2.1% would be slightly above that. So at 2.1%, you would only have a 20% probability of lifting rates next year if you were to use that measure, hitting an inflation rate of 2.1%. Now there's another way of looking at it, and then so on and so forth. So we're talking 30%, and then here probably somewhere around 70 in 2023, and then probably 90% in 2024. What's the probably with makeup? So the Fed moved its inflation target from just saying it was a threshold of 2% to an averaging out of 2%. So we're saying basically, if they underperform inflation for a certain portion of time, they would have to outperform that 2% target or 2.1% target for an equal amount of time. That would switch the probabilities even lower for them hiking, because that means they would need to overshoot the 2% for quite a while. So that decreases even their probabilities in 2022, 2023, and 2024. The third element that you introduce is currently the Fed is increasing its balance sheet, as we'll see on this here. On the blue line here, you see the Fed's balance sheet, and they keep on increasing. What tapering is called is when in 2018, the Fed started decreasing its balance sheet. So most people think that if the Fed were to start hiking interest rates, before it did that, it would have to start reducing its balance sheet. That's what this means by the taper constraint. So if you take into account the constraint that it would start by reducing its balance sheet before it even thought about thinking hikes, that even reduces further the probability that they would hike rates. And so essentially it means that there's only a 50% chance that they start hiking by 2024. So it's really pushing back basically rate hikes very, very far into the future. So this low interest rate environment seems like something that's here to stay for quite a while. Now I'm going to pause there a little bit and see if there's any questions to make sure that I didn't say something stupid, or that everyone sort of understands what I'm trying to convey. Any thoughts? Barry, did that make sense? But cool?
Yeah, that made sense.
That makes sense?
Makes sense.
Okay.
Yes, I like that.
Another way of looking at it is, so similar to the previous one, where here we're looking at rate hike probabilities. This is basically probability based on Goldman Sachs model of where inflation should be. Now, the flip side of it is, let's look at what interest rates are trading at. So you have different interest rate tradements that imply that the market is going to be hiking at a certain point in time. So the way that they're looking at this here is that you've got this red line, which is the market implied probability of the Fed hiking rates. So that's basically instruments that are traded in the market and what the implied probability would be. And then you've got the different thresholds for inflation. So if the 2% is the threshold for inflation, 2.1% the threshold for inflation, or 2.3%, then you've got different probabilities. And then you basically have what the probability is of reaching that versus the market implied probability. So what is sort of the takeaway here is that if there's a 2.1% threshold, the market implied rate of probability is under sort of the implied probability by the no constraint, but is much lower if you were to take the taper constraint. So it's essentially saying that it's almost as if the market is thinking that they're not believing the Fed, or they're thinking that they'll be a lot more aggressive in hiking than actually inflation statistics would imply. So it's essentially saying that the market is probably pricing higher interest rates more than they should be at this point, or at least based on what the fundamental analysis that's behind this is. So to a certain extent, it also probably means they're factoring in more growth and more inflation, generally speaking, than probably what would pan out in sort of a reasonable scenario. So that's interesting, because that may imply that there's a little bit more that the valuations are probably slightly higher than what they probably should be, given what the actual fundamentals would dictate, which is not too surprising. But it's also shown on the interest rate market, which generally tends to be a little bit more better at figuring out what the valuations are than equity markets do. And so just to point out how important taper is, and just reiterate that point, taper is probably what's been the biggest driver of equity returns over the past decades. And as you saw, when we tapered in 2018, we created a big period of sideways, and even that sort of crash in 2020, which they reversed very quickly because they realized that the credit markets were starting to seize up. Even here, as you saw, they did a huge amount of balance sheet expansion for the coronavirus crisis in March and then in April. They paused for a very brief while, and you had that slight correction around what was it, sort of, I think it was October, September. And then they said, okay, sorry, we didn't mean it, and they kept on expanding the balance sheet. So the movements by the central bank, by fiscal policy, again, are very important. Moving on to sort of positioning of the market, just to sort of reiterate a few points. This is what you can see here is on the top part is the commitment of is the price of the S&P 500, or the futures, and then below is what is called the commitment of traders. So futures are traded on an exchange, and when you're on the exchange, in this case the CME, you have to report what category of market participant you are: commercial, small speculator, or large speculator. Commercial being someone who hedges. And therefore, every future, because futures is a zero-sum game, for every person who's long a future, there needs to be someone who's short a future. What we see is that there isn't really a big positioning in futures. So all these three lines are close to zero currently, which basically means that not everyone is bought in. So what you would imagine is that if we were in a speculative mania, there would be essentially the speculators that would have bought a lot, and that they would be stretched in terms of positioning. So large spec and small spec. So the blue and green line would be very high, because everyone would have potentially bought it. Not so much the case at this point.
Daniel, how would positioning correlate with the VIX?
Well,
are they similar?
they're not very similar, but I wouldn't. I haven't done the analysis, but it would come to reason that if you had a strong positioning that is followed by a correction, the VIX would spike on the upside because people would have to get out of the position. So it would amplify moves, is what I'm saying. So imagine that everyone's long, or that there's a long contingent in the market, and the market starts collapsing. Those people who are long would have to sell it, especially if they're speculators, because they don't have a natural hedge. So they would need to get back flat so that they weren't losing money. That would amplify the move to the downside.
Does this mean, like, if I look at the chart on the 2018, are the commercials taking a beating?
On 2018, are the commercials taking a beating?
Meaning
No,
they're shorting there, right?
They're shorting it, but they can use. That's why I said commercials or hedgers, because, for example, let's say you're an asset manager that has bought a number of individual stocks, but you don't want to be too long the market, so you want to be neutral. So you bought a bunch of individual stocks on a cash basis, but then you short the futures to reduce your market exposure.
On the flip side, the small speculator, the blue ones, they seem to be smart at the beginning of a trend.
Yes, it depends. I'm not saying there's 100% correlation between what the market position is, but it definitely tends to exacerbate moves. And it's a measure of positioning. Nothing's 100% correct all the time.
Got it. Thank you.
Where did I? Let me just bring it. So I was going to go through a few. That's sort of the quick part of what I prepared. I was going to go through a few market charts just to give you a sense on where the technicals are. Can you guys see my charts?
Yes.
Okay, cool. Let's start with equities.
I think we're still seeing the slides, not the chart.
You are? Okay.
Yeah.
Okay, let me move to the charts. Can you see the charts?
Yes.
Yes. Okay.
So moving on to the chart portion. So I'll go with, I think this is quite interesting. So I'll make a few comments around this. You've had the S&P 500. So just noting that the S&P 500 is up, I think it's roughly something like 5% this year. Let's remove all these drawings. So if you look at that, call it 2021, or above, yeah, call it 5%, right? Now, if I were to go and find, so that's the S&P 500. Now, if I'm going to look at the Russell 2000, we're up 15% this year. Now, call it, yeah, roughly 15% this year. Now, what's interesting to note is that if you were to look at last year, that wasn't the case. The big outperformance last year was the FANGs. This is the FANG future. And if you look at the FANG future, since basically the bottom of the market in March, FANG futures are up 194%. So a lot of the recovery originally came from sort of the big market caps, and FANG means Apple, Google, Microsoft, Facebook, Amazon, and Netflix. And then recently, the market has shifted towards what one could call the more risky parts of the market. So the Russell 2000 or the smaller cap stocks. And that's not surprising. It's the secondary phase of the recovery. And also, I think with the prospect of the vaccine and maybe things unlocking a little bit, the equity, the big cap stocks have started to perform less well. Now, I don't think that means that Apple or Google are going to do badly going forward, but there's definitely been a little bit more oomph from the small cap equities. And I'll show a few interesting chart patterns that I've been noting. So this Apple has been breaking out of this consolidation period. So it's starting to break out a bit. Amazon has been sort of in a consolidation period as well. Netflix has been in a big consolidation period, basically since July. And then Google, on its earnings, it was in consolidation, then on its earnings, basically broke out quite a bit. So there's definitely room for these things to move now that they've consolidated quite a bit. So even though now that basically small caps doing 15% in what call it 1.5 months, that's like a year's return, generally speaking. So I wouldn't be too surprised for there to be some sort of mean reversion, at least from the bigger cap stocks. The other main themes that people have been seeing is China and generally foreign markets are doing well. And I like the emerging market graph quite a bit, and I'm going to put it on a really big graph. So I'm going to this is a monthly chart, but what you see here is it's really takeoff here. So this is VWO, which is the Vanguard International Equity Index Fund, and you can see that there's basically this 10-year consolidation on this chart, and you basically had this breakout, call it since mid 2020, of emerging markets, and it makes sense because it's a double effect. It's the effect that as you get a lot of fiscal stimulus and Federal Reserve easing, the dollar goes down, commodities do well. Emerging markets tend to be exposed to commodities, generally speaking, although this one has a lot of exposure to China, and because the emerging markets aren't basically creating as much liquidity on from their central banks, the depreciation of the dollar pushes up emerging markets in dollar terms. So it's not too surprising that this is a good way of also hedging essentially the debasement of the dollar or increased inflation in US dollars. So you have that in VWO, so in the emerging markets, but you also have it in sort of more developed markets. And I'll take for example Japan, which the Nikkei. There it is. The Nikkei, which basically, if you look at that, that's a very compelling argument that Japan, which has done very, very badly since basically the 1990s, is now really starting to pick up almost vertically because its value against the dollar is just doing much better, and you can see it on the USD JPY graph as well. So the dollar yen graph, as the dollar's been basically been getting hammered over the sort of more recent history. So it's probably a time where you get a decent amount of foreign performance from stocks, which have underperformed. They're also at lower multiples, and at this point, with cheap money, buying lower multiples helps. That was really all I had to talk about. There's a mention of that crude oil. You've probably all noticed that crude oil has gone just through the roof at this point. It's rebounded quite a bit. The main reason being that the Saudis have instituted cuts. So this is a monthly graph. So if I bring it back in daily, you can see here that oil basically had that collapse that was negative at one point during the coronavirus crisis, and since then has recouped quite a bit. What drove sort of this call it wave since the beginning of the year, which is quite substantial, is the Saudis announced that they would cut, so 22%. And on top of that, it seems like, and the reason they might have done that is because the Biden administration might be more favorable to Iran. So they might be foreshadowing that Iran might be coming back onto the market. So I don't think it was any secret that Trump was against Iran and that he basically curtailed them and then didn't let them sell their oil. If Iran were to come back to the market, that would be a lot more barrels on, and the Saudi, I think, have preemptively probably cut. So you could see probably a slight dip going into the second half of the year. Sorry, during the first half of the year, but it's still a bullish picture for oil just because of all the fiscal stimulus, and it's a good hedge to inflation. So oil and gold are good hedges to inflation. If you want to play this through, and again, it should be diversified. You shouldn't have a big component of your assets in oil. It can be played through USO. There are a lot of problems with USO, so I wouldn't recommend it as your first port of call for hedging inflation, because USO is an exchange traded note ETF, essentially. So it's a fund that uses futures to replicate oil. So it has a huge drag on performance. If I were to take this here, that's 130%, or let's take it not negative because oil price doesn't go negative, but let's call it 50% since that low. And if you were to compare it to this increase, you've got about 72%. So it has a huge drag due to the nature of the way it's built. Just bear that in mind. So if you can do futures, you're probably better off doing futures. again, that's a little bit more difficult. And if you really want to hedge inflation, gold is probably a better call. So IAU being the call for gold, the ETF for gold. That it's physical gold. It doesn't use futures. It actually buys physical gold. It has a lower expense ratio than GLD, which is the more liquid version, but it has a higher expense ratio. Anyways, that was a lot. That was it for my for basically what my prepared remarks. A few questions for you. So on technical analysis, and I'd love people to tell me. First of all, wait, let me ask if there's any questions, then I'll go to the technical, the option stuff. Any questions? Any thoughts?
Hey, Daniel, do you think that the opening up of the economy with more people getting flu shots and companies starting back up and employment edging up, that it will impact the price of oil along with the Saudis reducing output? So we'll have a squeeze on the oil?
I think a lot of that is already in the price. If you look at it, I think it was done by anticipation. If you look at sort of this chart of oil, it's gone. I mean, the rise is tremendous. Even if you consider October, where there was sort of that the second wave, call it, we're still up 42%. The one thing that surprises me is that I don't know if you guys have read in the news, but it seems like all the oil majors are literally getting out of the oil trade, like the big majors like BP, Shell. They're all saying we're quitting oil at sort of almost the wrong time. I think a lot of shale plays become very viable at this level. The question is there's backwardation in the market, which basically means the front price is higher than the backward price. So if you were to look at essentially December 2024 oil, again, not very liquid, it's around the 48. That's still deterring a little bit of people. And if you look at generally oil E&P stocks, they tend to trade on 2 years out. So 2023 is probably more logical. It's around 49. So that's still slightly low for shale to come back online, because what they like to do is typically they like to hedge like 3 years of production. And that's probably slightly low for them to say, okay, we're gonna make a gamble on it. You probably need to see something sustainable on sort of the 3 year to 4 year strip above $50 for shale to come back, is my guess. Again, that's not science, sort of.
Do you think that people switching over to electric cars is going to also impact that lower price at that time? So
the people switching to lower cars, I think, is going to be a tough one. I think it's going to be driven. It has been driven a lot by government subsidy. So there's that question around that. Then the constraint is on the metal side. If there's enough metals like cobalt, nickel, copper, are needed to build these EV cars, and then it'll probably drive demand through natural gas in the places where you can build natural gas, and then solar. So let me explain. So EV, of course, an electrical vehicle doesn't produce its own energy; it needs to charge it from the grid. In most places, the incremental megawatt is driven, generally speaking, by natural gas, because that's the most flexible one. And in California is slightly different, because we don't have we basically have such a hard environmental rules that we haven't built anything other than solar, I think, for like the past decade. We've shut down nuclear plants, we've shut down coal plants, we've shut down gas plants. We don't even build gas. So that's why we had blackouts, essentially. I don't know if you guys remember, but I got a blackout last summer. And that's due to the fact that we have a lot of solar and not very many flexible means of generation. So the EV coming online, I think, might drive natural gas prices up, because that's the easiest and fastest way to get new production online, that in order to compensate for the grid. We've got a lot of solar. A lot of problems on a lot of the grids throughout the United States is that there's so much solar and wind that they can't cope with variability. So they've sort of maxed out solar and wind. That's why battery storage is an option, which is being considered, but there's just not enough of it. So you might see some natural gas plants starting to get built. I don't know how the Biden administration is going to cope with that, because I think they're anti any fossil fuel. So there's a little bit of a conundrum there, how they're going to get there. A lot of this is driven by policy, which is sort of what I'm saying, and there's a lot of unknowns. The Biden administration is very favorable to solar. So I think their big push would be to build solar. But as they build solar, they're going to need some sort of flexible generation. And battery, there's just not enough battery storage in the pipeline right now to compensate for the amount of solar the solar power that they're thinking of installing. Does that answer your question or not?
Yeah.
Okay.
Thank you.
Any other thoughts, questions? So what I was going to ask you guys is, does it make sense for the next time around to do a course on options? So I've got something that's prepared. I'd love to show you if you're interested. And then in terms of technical analysis, so any thoughts on sort of the options class? Should we get back to that one? I know we skipped it. Are people still interested in that?
I am one of those.
Okay.
I would be very interested in options.
Okay, then we'll do the options class.
I would vote for that also.
Okay.
I do a lot with options.
Okay, great. I'll have to see how much in detail we go. And then the second thing was that the technical analysis question. What would you be guys interested in? I can probably do a brief lesson on technical analysis, but I thought what might be more interesting is sort of through that Twitter chat to create sort of a group discussion about chart patterns so that people can compare chart patterns and risk management. This is more for active trading. It's not really investing. So it depends what the group is interested in. What do you guys think?
Well, I think the technical trading is part of options trading. So, I mean, I combine fundamentals and technicals with good stocks to pick the options that I want to trade on.
Okay. So, so are you guys interested in using Twitter as a means of communication? Because there's a lot of things that probably can be discussed real time, and I feel we don't have a forum for that. Is that the best venue, or do people have other thoughts on venues or means of?
I don't have Twitter.
It's very easy to install. You literally just go online, you type Twitter, and you get an account.
Okay, I'll go with whatever everybody wants.
But if there's another means that you think we can go back and forth, it also keeps sort of a log that people can read whatever comments are, and I don't know. It was I thought the cheapest and easiest way to communicate that most people might have. But if there's another venue, or if there's no interest in using sort of a chat style dialogue, happy to go with whatever you guys want. I don't have a strong opinion.
Yeah, I'm not familiar with it. I haven't used it, don't have an account, but I'd be willing to go with whatever the majority says.
Okay. Anybody else? Anybody have thoughts on that?
I'll go with whatever the majority goes with.
Okay. So I'll just repost the link in case you are interested and you want to see if it's easy to figure out or not. Did everyone get the link originally? That's in the chat, so you can copy it now. I don't think I have everyone's email. I'll put it back in there again. But essentially, what you have to do is you've got to create an account and then follow that account, which is basically the AAII Los Angeles. I just created an account and called it AAII Los Angeles. Sound good? That's it for me today. If there's no other questions or comments, we'll call it a day.
Good presentation.
Thank you. I hope it was helpful.
Yeah, thank you so much.